If you think this is just another buy the dip moment, you aren't looking at the math. This is a structural regime change. The great repatriation of capital is moving money out of US tech and back to Tokyo. Are you holding through this, or are you moving to real assets? Drop a cash in the comments if you're de-risking, or tech if you think the AI boom can survive a 1% yen rate. Let's discuss the patterns below. The floor just dropped, and nobody's talking about the real reason why. We've spent 30 years treating Japan like the world's bottomless, interest-free ATM. But as of this week, the machine just flashed a system error and started demanding its money back. That 0.75% rate from the Bank of Japan, it's not just a number on a spreadsheet, it's a death knell for the era of free money. The infinite money glitch that fueled the Nasdaq, the Silicon Valley AI boom, and the entire global debt bubble, it just got patched permanently. The mainstream narrative is trying to gaslight you. They're calling this a minor adjustment or policy normalization. It's total garbage. You don't normalize after 30 years of 0% addiction without the entire patient going into cardiac arrest. The trajectory is undeniable. We are looking at the highest rates in Japan since 1995. Do you realize how much global leverage is built on the assumption that the yen would stay at zero forever? Trillions, not billions, trillions of dollars are currently caught in a massive, high-speed reverse carry trade. Every time you see the Nasdaq shudder or your tech-heavy portfolio take a random 4% hit in an afternoon, that's not market volatility. That's the sound of a margin call echoing from Tokyo to New York. The leveraged funds are being hunted. They borrowed yen at 0% to buy Apple, Nvidia, and Microsoft. And now that the yen is getting stronger and the interest is actually, existing, they're being forced to liquidate everything to pay back those loans. They are killing their winners to survive the night. This hits your safety tomorrow because your retirement, your index funds, and the very stability of the US dollar are collateral in a game that just changed its rules mid-match. The global tech miracle of the last few years? A huge chunk of that wasn't innovation. It was just yen-funded speculation masquerading as growth. Now, the math is breaking, the spread is gone, the arbitrage is dead. But here's the terrifying part, the part they're desperate to keep off the front pages. This 0.75% move is just the trigger. There is a secondary mechanism, a hidden gear in the global debt machine that is about to engage. When it does, these episodic shocks we're seeing in the markets will look like the calm before a hurricane. You think the tech sector is correcting? You haven't seen anything yet. Not until you understand what happens when the world's largest creditor nation finally decides to bring its trillions of dollars back home. It's all connected, and it's all starting to unravel. To understand how we got to this ledge, you have to look back at the last decade, specifically the post-2015 era where the world decided that Japan was just a permanent static feature of the landscape. We treated the Bank of Japan like a utility, like the power grid. You don't think about the grid until the lights go out. For years, the BOJ was the only thing keeping the global everything bubble from popping. They were the ones providing the liquidity when the Fed was trying to tighten, the ones buying up their own bond market until they owned more than half of it just to keep rates at zero. It was a global subsidy for risk, and Wall Street was the biggest beneficiary. Now, the standard argument you're hearing from the experts on cable news is always the same. They say, calm down, it's only 0.75%. The US survived 5%. Europe survived 4%. Japan is still historically cheap. That argument is a fundamental delusion. It's a category error. It's not about the absolute number. It's about the mathematical leverage built on top of that number. When you have $10 trillion, and yes, the shadow banking estimates are that high, borrowed at 0%, a move to 0.75% isn't a small increase. It's an infinite increase in the cost of carry. It's the difference between a business model that works and one that is a guaranteed loss. The spread is the heartbeat of the global financial system, and the BOJ just gave that heart a massive 75 basis point shock. The villain here isn't the Bank of Japan. They're actually the ones finally trying to stop the house from burning down. No, the real villain is the institutional addiction to that cheap yen. Every major hedge fund, every massive private equity firm, every too-big-to-fail bank has been using the yen as a backdoor to fund their highest risk bets. They've been using Japan's stagnation to fund Silicon Valley's disruption. It was a parasitic relationship. The world was sucking the life out of the Japanese saver to keep the Nasdaq at all-time highs. And now the parasite is being detached. When that index drops, when you see the Nasdaq bleeding out, it doesn't stay on the screen. It translates into real-world pain. Think about the U.S. Treasury market. For years, Japanese institutional investors were the largest foreign holders of U.S. debt. They were the ones lending the U.S. government money so we could fund our deficits. Why? Because 1% in the U.S. was better than 0% in Tokyo. But now, with the yen strengthening and BOJ rates hitting 30-year highs, those investors are doing the math. And the math says go home. They are selling their U.S. treasuries to bring that capital back to Tokyo. When they sell, bond prices drop. When bond prices drop, yields rise. That means your mortgage rate in the U.S., your car loan, your small business credit line, it all gets more expensive because a group of bankers in Tokyo decided they were tired of being the world's doormat. The mainstream will tell you there's an easy fix. They'll say the Fed will just pivot. They'll cut rates to 3% or 2% to save the market. It's a trap. If the Fed cuts rates while the BOJ is hiking, the interest rate differential narrows even faster. That makes the yen even more attractive. It makes the reverse carry trade even more violent. Every rate cut from the Fed is actually a signal to the markets to sell more U.S. tech and buy more yen. It's a pincer movement. They are trapped by the very math they used to inflate this bubble in the first place. The false hope is believing that 2026 will be a return to normal. It won't. Sticky inflation in Japan, hovering near 3%, means the BOJ is essentially being forced to keep hiking just to keep their own currency from collapsing. They have reached the limit of their patience. They're watching the world's investors treat their currency like a plaything, and they finally decided to break the toy. The context is simple. The world's largest creditor is calling in its markers, and the world's largest debtors, the U.S., Europe, the tech-heavy growth markets, don't have the cash to pay. They only have the assets they bought with borrowed money, assets they are now being forced to dump into a falling market. It's not a correction, it's a liquidation. To really grasp the gravity of what's happening, you have to stop thinking about interest rates as just a number on a chart and start seeing them as the gravity that holds the entire financial universe together. Imagine you're at a massive, ultra-high-stakes casino. For 30 years, the house, the Bank of Japan, has had a very specific, very weird rule. They give out free drinks, free chips, and most importantly, they let you borrow as much money as you want at 0% interest. The only catch, you have to take that money and gamble it somewhere else. You can't spend it in their casino. So what does everyone do? They take those stacks of free yen, they walk across the street to the Nasdaq casino or the emerging markets lounge, and they bet it all on the flashiest, highest growth tech stocks they can find. If you borrow $1 million at 0% and make even a tiny 2% return on a safe stock, you're a genius. If you put it into a hyper-growth AI stock that jumps 20%, you're a god. You're playing with house money, and the house doesn't care. But then, one night, the manager of the yen casino walks over to the microphone. He clears his throat and says, Effective immediately, the money isn't free anymore. It's 0.75%. And by the way, we might move it to 1.0% by next summer. Suddenly, the air leaves the room. Every single person who borrowed those millions of yen realizes they have a bill due. And because the yen is suddenly worth something again, the currency itself starts to climb in value. Now, you don't just owe the 0.75% interest, you owe back a currency that is getting more expensive by the second. This is the mechanism. It's a toxic relationship that we've mistaken for a healthy economy. We've been dating cheap yen for so long that we forgot what it's like to pay for our own dinner. The global financial system is addicted to this spread. It's like a failing engine that's been running on a specific type of high-octane fuel that only one gas station in the world produces. That station just changed the formula and the engine is starting to knock. I know, it sounds impossible. You're thinking, surely they can't let the whole thing fall apart over a fraction of a percent. But that's the empathy trap. You have to understand that the decision makers at the BOJ are trapped by their own math. They aren't raising rates because they want to crash the Nasdaq. They're raising rates because they're looking at their own people, the Japanese retirees whose savings are being evaporated by 3% inflation, the families who can't afford imported food because the yen was too weak. They are being forced to choose between the global tech bubble and the Japanese social fabric. They're choosing their own people. And in doing so, they are pulling the pin on a grenade that's been sitting in the middle of the global tech floor for 3 decades. It's a domino effect that feels inevitable once you see the sequence. Domino A, the BOJ raises rates to 0.75% to fight domestic inflation. Domino B, the yen strengthens as investors stop selling it and start buying it back to pay off their debts. Domino C, the carry traders, the hedge funds and banks, suddenly find their free money is costing them billions in interest and currency losses. Domino D, to stop the bleeding, they have to sell their most liquid assets. They sell the stuff that's easy to move. Apple, Nvidia, the S&P 500, the Nifty 50. Domino E, the massive sell-off creates a liquidity vacuum. As prices drop, more margin calls are triggered. More people are forced to buy yen to close their positions. Domino F, the yen gets even stronger. The cycle repeats. It's a feedback loop from hell. We call it deleveraging, but that's a sanitized word for panic. It's what happens when the tide goes out and you realize everyone was swimming naked, but they were all tied together with the same yen-denominated rope. The mechanism is designed to be stable at 0. It is fundamentally unstable at anything else. When you build a skyscraper on a foundation of ice, you don't need a blowtorch to bring it down. You just need the temperature to rise 1 degree above freezing. We just hit that degree. The ice is melting. The global tech miracle was never a miracle. It was a carry trade. It was a mathematical arbitrage that worked until it didn't. And the scariest part? Most people still think this is a buying opportunity. They think the engine just needs a tune-up. They don't realize the fuel is gone. They don't realize that the cheap money era wasn't a phase of capitalism. It was a 30-year anomaly that just came to a screeching 0.75% halt. The casino is closing the free credit window. The lights are coming up, and everyone is about to find out exactly how much they actually owe. The ugly truth is that we are staring at a structural reset that most people aren't mentally prepared for. Drop the optimism. It's a liability right now. The statistical reality for the next 6 to 12 months is a grinding, painful repricing of everything you thought you knew about value. If the BOJ hits that 1.0% target by mid-2026, and the way inflation is sticking at 3%, they almost certainly will. The global tech correction isn't just a dip, it's a regime change. We are transitioning into a world of scarcity capital. For 30 years, capital was a commodity. It was everywhere, it was cheap, and it sought out the most speculative, disruptive nonsense it could find. In 2026, capital becomes a predator. It will only stay where it is safe, where there is actual cash flow, and where it isn't tied to a ticking yen-denominated time bomb. The vision of the future society based on this trend? It's a return to gravity. Imagine a world where growth at all costs is replaced by survival at any cost. We're going to see a massive bifurcation. On one side, you'll have companies and even nations that are yen leveraged, the ones that binged on the cheap money and now have to liquidate their futures just to pay the interest. On the other side, you'll have the cash-rich sovereigns. The power is shifting back to the creditors. Tokyo is effectively reclaiming its status as a global financial superpower, not through innovation, but through the simple act of charging rent on its currency. You're going to see ghost unicorns in Silicon Valley, companies valued at billions that suddenly vanish because their bridge loans were tied to carry trade liquidity that evaporated overnight. You're going to see emerging markets that were the darlings of the 2020s suddenly struggling to keep the lights on because the dollar-denominated debt they carry is being squeezed by a rising yen. It's a world of economic realism. The era of the app for everything is being replaced by the reality of everything. So let's talk heart to heart. What should you actually do? First, you need to build mental fortitude. The volatility you're seeing now, those 4% drops that feel like the world is ending, that's going to be the new normal for a while. You have to stop checking your portfolio every 10 minutes. That's how they bait you into selling at the bottom. You need to detach your self-worth from the line on the screen. The line is going to be erratic. The math is breaking, and the market is trying to find a new floor in a room with no floor. Second, focus on real assets and cash flow. The infinite money glitch favored dreams. The scarcity regime favors reality. If a company doesn't make a profit today, it's a liability tomorrow. If an investment relies on cheap debt to be profitable, it's a trap. Look for the survivors, the entities that don't need to borrow to exist. Third, find your community. The digital truth isn't just about the numbers, it's about not being alone when the narrative collapses. When the mainstream media starts screaming that everything is fine while your grocery bill tells you otherwise, you need a tribe that speaks the language of math, not the language of propaganda. The sign-off is simple. The game was rigged for 30 years, and the people who rigged it just hit the reset button. Don't be the collateral damage in their liquidation. The era of cheap money is dead. Long live the era of economic truth. Trust the patterns, not the promises. I'll see you in the comments.